Thank you guys for clicking on today's video. Today we're going to go over how to average down. So basically, averaging down means to take your current position and seeing a drop in its value and then repurchasing shares into that company at a lower price in order to make your current average of that stock lower to what it previously was at. To give an example of this, let's say you buy Apple at $200 a share and you buy 10 shares. Your average price is $200 a share. Now let's say short term, Apple takes a dip in the market and drops down to $50 a share. You still bought Apple at $2,000, but your account now is only worth $500. So in order to break even, you needed to go back to at least $200. So to average that down, you decide to buy 10 more shares at $50. So now you have 20 shares at $50. You are now $2,500 into this position. So in order for you to break even, you now only need the stock to go back to $125 a share, making your new break even price $75 lower than your previous price. This method of investing seems foolproof as long as you don't run out of money. And you don't have to use it for a buy and hold. You could use it short term, long term, however long you want. The problem with this is that eventually you will run out of money. A great example is Brian Hunter. Brian Hunter was a trader over at, now excuse me if I pronounced this wrong, Amaranth Advisors, which was a huge hedge fund with over $9 billion in assets in 2006. What he wanted to do was he wanted to trade in natural gas. However, with his position, natural gas dropped down to below $4. Him ignoring the market and believing that this would eventually go back up, he decided to average down his position. And soon enough, JP Morgan, which was his broker at the time, kept calling for more collateral to support his enormous position. And when the collateral didn't arrive, he was forced to liquidate his positions, going from $10 billion in assets to just $4.4 billion, taking a $6.6 billion loss, which eventually led to the company being dissolved entirely. So even though this does seem like a great method of investing, eventually you will always run out of money. Make sure you listen to the market and pay attention to what's actually happening. If it's not just a short-term correction, but actually a long-term correction. Thank you guys for watching. Remember to leave a like, comment, subscribe for more future content.